Welcome to DeWitt Dunn Financial Services with your host, Kathy DeWitt Dunn.
And welcome back. I'm Kathy DeWitt Dunn along with Steve Ringo. Thank you so much for joining our show this weekend. We're glad that you're with us. We have a lot of great things that we're going to be talking about. And Steve, it's great to be here.
Great to be here. A little chilly this weekend, but glad we're here. Couldn't think of any other place I'd rather be.
Well, it's the first weekend of March. It's our birthday month, isn't it?
Yes. For that.
Yeah,
yes.
How about that? That was not an official clap. No, but we're glad that you're with us, and we're excited to be here. We're going to talk about a lot of different things. But, you know, one of the challenges for the investor is you know, we've got a lot of great, we do a lot of research with our show, and sometimes we get to it and sometimes we don't. But I think one of the challenges is that, you know, I'm not a fan of the 200-day moving average. And if you take a look at any good investor knows that you can't time the market. If you could, you'd already be retired, right?
Right.
And it's, you know, so what do you do? What are your options? Well, you need to really work with someone that can narrow down your options. There's too many choices out there. There's too much noise. Every time you go to move an account or, you know, you find a new advisor, the other advisor's completely freaking out because then they have to report that they now have lost an account. So of course they're going to be sitting there clawing to try to get, you know, you not to move. They're going to, you know, create all of these doubts and make you feel like you made the wrong decision, maybe make you feel like, you know, you're getting a divorce from them. Maybe you should, by the way. And it's just a challenge because what are the investors, what should they do?
Right. Well, and I mean, that's so real, right? Because these advisors are getting so desperate, and you know that you're making the right decision at that point because all they're doing is delaying and delaying. I mean, there was a couple that we dealt with this past week where it was like, it wasn't just a day, it was several days of the advisor just delaying and delaying. And what happened to our new clients' assets? It went down a little bit, right? Because there was volatility, right? And the last thing that we want to do in retirement is risk your hard-earned money. I mean, you've worked so hard your entire lifetime to come up with these funds. We need it to bridge the gap in between Social Security, if you have a pension, and income. I mean, we need to fill that gap. And the only way to do that is with the money that you've worked hard to accumulate.
Right. And you got to look at different fixed income options. And we're not talking about money markets or CDs. We are talking about what the high net worth client is doing right now. And they're looking at the fixed index annuities. Did you know you can have one inside of your portfolio with no fee? Now, obviously, there's rules to the different programs. We work with all the different companies. But one of the rules that I really like the most is that your value cannot go down due to market risk. And that's the biggest thing, right? So that's like making a lot of money.
Right.
But I think, you know, I think one of the challenges, though, is this past week is I had an investor that came in and he was about 73, 74, married couple. And their accounts were probably somewhere, IRA accounts were around like probably close to 700,000, but divided between both of them. And she said they went in to talk to their advisor. They hadn't met him before. And she said, I think he was as old as one of my grandchildren. And she said, and immediately I felt uncomfortable.
Right.
Because, you know, they haven't been through, you know, the .com, 9/11, 08 and 09, and they're managing my money. And I looked at her and like, yes, do not work with someone who does not have any assets. Rule number one of picking an advisor, if you think about it, right? Because you have to make sure that they have your best interests at heart and they're a fiduciary. But I can tell you right now, I don't want to work with someone that's broke or someone that just started off or with somebody who doesn't have any assets whatsoever. That is not a good scenario for you or for anybody else they're working with. And, you know, what are they going to do if this market corrects? Well, they have no idea. They don't understand how that impacts your income later down the road. Or, you know, if you're going to go to retire, you know, how much money you really need. What is the planning process? I mean, you know, just look at them across the table. What's the value of your IRA, dude?
Right.
I mean, you know.
Well, and we had something come up this past week where we were on the phone with another advisor and we were talking about 07 and 08, how the market started to decline. And then it went down from 08, 2009, February 2nd. And he was like, I was still in college then, right? And it was a huge problem because he's not aware that when the market goes down, it can go down pretty quickly. And that's the last thing you want for your retirement monies.
But no. It always comes back, Steve.
It does. It just takes the time.
Right. And also, you know, if you need income, it's just not a great way to, you know, that is not a road that I want to take. You know, when you are planning for retirement, it's like a vacation. you need to get a map. You need to pick the destination points between now and when you retire, and you need to have a checkup. And you need to exit the freeway to see, am I on the right path? It's okay sometimes to get off on the wrong path, but you've got to get back up on the highway, get on down the road so you can have a great retirement. And that's the reason why I just love the fixed indexed annuities, is I get the upside of the market, but I don't have the downside of the market. But obviously there's a trade-off, 70 or 80% of a great market and 0 of a negative, because there's no investment out there that says I get 100% of the upside of the market and I get 0 of the downside, and I have I have a 100% liquidity. That does not exist. So you have to pick and choose what's more important to you. And all the different companies on the fixed index annuity side that we work with, you have 10% liquidity annual, and you can, take out, 1% a month up until you've taken out your 10%. Or you can have a guaranteed lifetime income. I mean, what are your goals and objectives?
Right. And for our clients, listeners, and also viewers, the numbers that we talk about, the choice is really simple, because when we're dealing with a high net worth indexed annuity that gives you the upside potential that's far greater than the other ones, it's truly a no-brainer.
Oh, it is. And Steve, let me just take a look. Here we go. We talked about this earlier on our show. We're getting high tech. We're starting to record, and we're going to start disturbing all this so you guys can see it. But here's a gentleman which mentioned before, age 74, an IRA, $1.7 million, and he's only going to take out his RMD. And on the bottom, this is the worst case scenario and what the markets have performed at during the worst 10-year period, which I think I would rather talk about that than the best. The best is easy,
right,
but let's talk about the worst, because that's really what's going to impact you. So obviously he's going to start taking his RMDs at age 75. He's been taking them, or at 74, I'm sorry. And then we've taken out over $1 million in RMDs over a year period. And his IRA value is $2,251,000 with an average rate of return of 8.75 in the most unfavorable period with no fee. And let me tell you why that rate sounds high, because there's no fee. Now, if I were to charge 1.5, or if the companies were, your rate of return would be in the 6. There's no fee. That's the reason why this is such a high rate of return with no risk to your principal. That is an outstanding opportunity for people with IRAs. And it's interesting that 89% of IRA money goes into annuities. Just because people don't want to have their income going down later down the road, is preservation of capital, and they don't want their income level to be impacted in the event that there is a correction. Right.
So for all of our listeners out there, pick up the phone, give us a call today. I'm sure you've been promised a higher return, but then have had some losses. The number that we can be reached at today is 972-473-4700. Again, that's 972-473-4700.
And I guess, when you're really thinking about retirement, what are your goals and objectives? You need to be able to go out and have fun and not be worried about the market, not playing the market, not playing the 200-day moving average and sitting in cash and not making any money and worrying about it. You need to make sure that you've got income coming into your accounts so then you can enjoy your retirement. Go take your grandkids. We have a lot of our clients that take their grandkids on amazing trips. I would like to be up for adoption on that. But isn't it just like, we had one client that I think he had 20 kids that they took on vacation.
Right.
And he paid for everything.
Well, and then we have some clients that don't take their kids on vacation because they're worried about spending money. But these are people that have worked so hard over so many years and have the money to go and do it. And when they know that their principal is protected and they could have income and not erode at their principal, then they're more inclined to do that.
Absolutely. If you'd like to schedule a free appointment or come out and visit with us, we have offices in Dallas, Fort Worth, and in Houston, Texas. The number to reach us is 972-473-4700. Again, that's 972-473-4700. Or you could look us up on the web at DeWittandDunn.com.